Foreclosure starts in America have hit their highest level in 6 years. 273,000 active foreclosures right now, according to Intercontinental Exchange mortgage technology data released just days ago. That's up from 213,000 a year ago. And bank repossessions are now surging 45% year over year. That's why today we're taking you through exactly how the biggest mortgage collapse in U.S. history just got worse. Because everything we've gotten in the last 60 days from ATTOM Data Solutions, from the Mortgage Bankers Association, from the Federal Reserve itself, tells us Phase 2 has shifted gears and the foreclosures hitting a 6-year high is just the beginning. In Lakeland, Florida, 1 out of every 409 housing units is now in some stage of foreclosure, the worst rate of any small metro in the country. 3 things you need to understand. Number 1, we're going to show you the specific FHA loan vintages where 65 to 70% of borrowers are already underwater on their mortgage, and which cities those vintages are concentrated in. Number 2, we're going to explain why the auto loan delinquency rate just hit a level we haven't seen since 2010, and what that means for housing. And number 3, we're going to break down what just happened in the Homebuilder Q1 earnings reports we got this month. Because Lennar's executive chairman said one sentence on his March 12th conference call that captures the entire builder collapse. And we're going to play it for you. Let's start with where the actual damage is happening. ATTOM Data Solutions just released its Q1 2026 foreclosure report on April 16th. 118,727 properties had foreclosure filings in the first quarter alone, up 26% year over year, the 12th consecutive month of annual increases. Foreclosure starts hit 82,631, up 20% year over year. And bank repossessions, the actual completed foreclosures where the lender takes the house back, came in at 14,020, up 45% year over year. Now, the year-over-year jumps in specific states are where this gets serious. Colorado completed bank repossessions went from 99 a year ago to 321 today. Alabama went from 153 to 355. Florida from 487 to 1,014. Florida's completed foreclosures more than doubled in a single year. Washington State went from 104 to 224. Oregon from 80 to 170. These are not small percentage changes. These are families losing their homes at multiples of last year's pace. Rob Barber, the CEO of ATTOM, said it directly. Foreclosure activity increased in the first quarter, with both starts and completed foreclosures posting solid year-over-year gains. The continued rise, especially in starts and bank repossessions, suggests financial pressure may be building for some homeowners. The metro picture is even more striking. Lakeland, Winter Haven, Florida, currently has the worst foreclosure rate of any small metro in America. 1 in every 409 housing units. Punta Gorda, Florida, and Columbia, South Carolina are right behind it. At the state level, Indiana now has the highest foreclosure rate in the country at 1 in every 739 housing units, followed by South Carolina and Florida. And the data point that should stop everyone in their tracks is this. According to Intercontinental Exchange Mortgage Technology's first look report from April 24th, the active foreclosure inventory now stands at 273,000 homes. That's the highest level we've seen in this country since February 2020. 6 years ago. A year ago, that number was 213,000. So 60,000 more American families are in active foreclosure today than were a year ago. So, who are the people losing their homes? This is where I promised we'd break down the FHA vintage data. And this is what nobody is showing you. According to Intercontinental Exchange Mortgage Technology's most recent mortgage monitor, here is the concentration of negative equity by city and loan vintage. In Cape Coral, Florida, nearly 70% of FHA loans originated in 2023 and 24 are already underwater. 70%. In Austin, Texas, 65% of FHA loans from 2022 are underwater. In Northport, Sarasota, 57% of 2023 vintage FHA loans are underwater. 8 metropolitan areas now have more than 1 in 20 of all homes in negative equity. Tampa, 5.4%. Colorado Springs, 5.6%. Jacksonville, 6.3%. San Antonio, 8.8%. Austin, 9.2%. Cape Coral, 10.1%. And Lakeland, Florida. Yes, the same Lakeland with the worst foreclosure rate in America is now at 10.8% of all mortgages underwater. Cotality, formerly CoreLogic, released its Q4 2025 homeowner equity report on March 26th. The number of underwater borrowers nationally is 1.1 million, up 15% year over year. Florida homeowners lost their most equity per borrower in the country last year, negative $29,400 on average. Here's the simple math so you understand what this looks like up close. A first-time buyer in Cape Coral bought a $350,000 home in 2023 with an FHA loan. They put 3.5% down, $12,250. They financed $337,750 at 7%, with a monthly principal and interest payment around $2,250 before taxes and insurance. Today, that home is worth about $305,000. They owe more than the home is worth. They can't sell without bringing money to closing. They can't refinance. If they lose a job, get sick, get divorced, get transferred, they go to foreclosure. That's not a hypothetical. That's happening right now to thousands of families. This is what Phase 2 looks like up close. It's not a market crash where everyone loses 20% overnight. It's concentrated, surgical destruction in specific cities and specific loan vintages, while the rest of the country gets told everything is fine. If this market intel is helping you make better decisions, tap the bell, not just subscribe, the actual bell, because YouTube buries channels that don't get notification opt-ins. The viewers who catch these videos in the first hour get the best information. The ones who catch them 3 days later are reacting to news everyone else already moved on. Tap the bell, you'll see every video the moment it goes up, and you'll be ahead of 90% of the market. Now, let's talk about why none of this is getting fixed. Mortgage rates actually broke below 6% on February 26th of this year. Freddie Mac's primary mortgage market survey reported the 30-year fixed at 5.98%. The first sub-6% reading in more than 3 years. The narrative for about 10 days was that spring was finally going to thaw this market. Then a war broke out. At the end of February, military operations began in Iran. Oil prices spiked. Gas hit $4 a gallon. Inflation expectations re-anchored higher. The 10-year Treasury yield ripped from below 4.1% to 4.35%. And mortgage rates blew right back up. By April 2nd, Freddie Mac reported the 30-year average at 6.46%. That's a 48 basis point increase in 5 weeks. On a $400,000 mortgage, that's roughly $130 more per month, over $1,500 a year. Just from a war. Rates have come down a little since. They're at 6.23% as of last week, but the damage was done. Every spring buyer planning to lock at 5.99% got priced out. And here's the most important part. The Federal Reserve held rates steady at its March 18th meeting on an 11-1 vote. In the summary of economic projections, 7 out of 19 Federal Reserve official members are now projecting 0 rate cuts for the rest of 2026, up from 6 in December. The Fed's own statement now includes this line: the implications of developments in the Middle East for the U.S. economy are uncertain. Jerome Powell said it on March 18th in plain English. Activity in the housing sector has remained weak. He also said this, and pause on it. Effectively, there's 0 net job creation in the private sector after accounting for revisions over the past 6 months. So, we have a foreclosure crisis accelerating, an underwater problem concentrated in FHA vintages, a war that just torched rate forecasts, and a Fed admitting that the private sector has stopped creating jobs. This is not the setup for a housing recovery. Here's where I promised you the Homebuilder earnings, and this was the biggest tell in the entire data set this quarter. Every public home builder that reported Q1 2026, except for luxury builder Toll Brothers, printed multi-hundred basis point year-over-year gross margin compression. Lennar reported March 12th, gross margin 15.2%, down 350 basis points year-over-year. Earnings per share down 56%. Average selling price down 8% to $374,000. KB Home reported March 24th, gross margin 15.3%, down 490 basis points. EPS down 65%, revenue down 23%. They cut guidance. But wait, it gets worse. Meritage Homes reported April 22nd. Gross margin 17.5%, down 450 basis points. EPS down 51%. Cut guidance. NVR, the most disciplined builder in the country, reported the same day. Gross margin 19.6%, down 230 basis points. Settlements down 22%. Missed estimates by 14%. D.R. Horton, the largest home builder in America, reported April 21st. Gross margin down 170 basis points. EPS down 20%. Cut guidance and confirmed Gulf Coast layoffs. Pulte Group reported April 23rd. Gross margin down 310 basis points. EPS dropped from 2.57 to 1.79. The Pulte CEO said, quote, Q2 will be the low point. Now, here's the quote I told you about. This is Stuart Miller, executive chairman of Lennar, on his March 12th earnings call. Normalized incentive levels run 4 to 6%, compared to the 14% we're carrying today. 14%. Builder incentives are now more than triple historical norms. That means when you see a builder advertising a $50,000 incentive on a $400,000 home, that is not generosity, that's desperation. They're paying buyers to take inventory off their books because the alternative is worse. And then there's the John Burns Research Industry survey from this quarter. 63% of U.S. home builders said local peers had recently conducted layoffs. In Texas, 87%. Florida, 79%. Robert Schottenstein, the CEO of MI Homes, on his April 22nd call, said there's just so much uncertainty. During our last conference call, we weren't talking about a war. We weren't talking about $4 gas prices. In 90 days, look how things like that have changed. Here's the supportable but controversial take, and we'll let you fight us on this in the comments. The home builder business model is structurally broken right now. They built massive amounts of inventory between 2020 and 24, betting that low rates would return. Well, they didn't. They're now paying buyers 14% incentives to clear that inventory. When those incentives end, prices will reset down to whatever clears the market without the subsidy. That's not a forecast, that is math. The big public home builders are propping up new home prices artificially, and when they stop, resale comparable sales will follow them down. If you're buying new construction in 2026, you should assume the home you're signing for is worth 10 to 14% less than the contract price the day you sign. Hit the like button if that take made you uncomfortable, and drop a comment telling us whether you agree or disagree, because this is exactly the kind of conversation YouTube's algorithm rewards. Whether you think we're right or whether you think we're dead wrong, we read every comment, and the channels that grow are the ones with active communities, not passive viewers. Speak up. Now, I told you at the top I'd explain why the auto loan delinquency rate just hit a level we haven't seen since 2010. Here it is. According to the New York Federal Reserve's quarterly report on household debt and credit released February 10th, the 90-plus day serious delinquency rate on auto loans is now 5.2%. The peak in the 2010 financial crisis aftermath was 5.3%. We are within 0.1 percentage point of matching the worst auto loan delinquency rate in modern American history. Why does this matter for housing? Because consumer credit stress doesn't stay in one bucket. When families can't make their car payment, they're already triaging their bills. The mortgage gets paid first because the family lives there. The car gets paid second because they need it to get to work. So when 5.2% of auto borrowers can't make their payment after 90 days, the question isn't whether mortgage stress is coming, it's how soon it shows up. And here is the second piece. Multifamily commercial mortgage-backed securities. That's the big apartment building loan market. Just hit an all-time high delinquency rate of 7.15% in March 2026. Brand new record surpassing the prior peak from October 2023. 80% of all new multifamily distress in March was concentrated in just two markets, New York, New Jersey at 48%, and Houston at 30%. These are mostly term defaults, meaning operating cash flow is breaking, not just refinancing math. Apartment landlords cannot make their loan payments out of rent collection. That hasn't happened at this scale in the modern era of CMBS. Office CMBS delinquency also hit an all-time high, 12.34% in January. That distress is bleeding into regional banks who hold these loans on their balance sheets. Auto loans matching 2010. Multifamily and office CMBC at all-time highs. The foreclosure pipeline at a 6-year high. If you tell me the credit cycle is fine, I'm going to ask you which data set you're looking at. In the last video on this subject, I told you the Northeast and Midwest were the markets everyone called safe, but that we were watching for warning signs. Here's the update, because the cracks have started. The S&P Totality Case-Shiller Index released today, April 28th, for February data. Denver just overtook Tampa as the worst performing major market in the entire 20-city index. Denver is at negative 2.18% year over year. Tampa is at negative 2.06%. Seattle is now negative 2%, with active listings up 42.5% year over year. The largest inventory increase of any of the 50 largest metros in America. Phoenix, negative 1.78. Dallas, negative 1.74. But here's the data point that should make every Northeast homeowner pay attention. Boston metro median home prices, according to Homes.com data for February, just posted a 3.7% year-over-year decline. That's the first month-over-month drop in nearly a decade. Sales are down 8.5% year-over-year. 60% of homes are now selling below list price, up from 50% the year prior. Realtor.com data for March shows Boston list prices down 4.6% year-over-year and active listings up 15.3%. And the existing home sales report from NAR for March showed something I want every viewer in the Northeast to hear. Northeast region existing home sales fell to a 430,000 seasonally adjusted annual rate. That's the lowest reading on record in NAR's regional series going back to 1999, down 12.2% year over year. The Midwest region is at 920,000, matching the weakest pace since 2011. Hartford is still the hottest market in America by Realtor.com's measure. Chicago, New York, and Cleveland are still the top 3 on Case-Shiller's annual gains. So the safe markets aren't all collapsing, but Boston has cracked. The Northeast region just printed its lowest sales month on record. And if you own in any of these markets right now, you need to be paying attention. So let's bring this home because I want each of you to know where you stand. If you're a homeowner, the question isn't whether your home is going to lose value tomorrow. It's whether your equity is being eroded right now and whether you're in a market where it's accelerating. Look at your metro on the data I just walked through. If you're in Lakeland, Cape Coral, Austin, Phoenix, Denver, or now Boston, you should know your number. If you're a seller, here's the brutal truth. Daryl Fairweather, the chief economist at Redfin, said it last week. We have about 600,000 more sellers than buyers nationwide. If you actually need to sell in 2026, price aggressively now. Every month you wait costs you more because builder incentives are pulling buyer demand away from resale, and those incentives aren't going down, they're going up. If you're a buyer, this is the most important moment in the cycle. Don't buy new construction in a Sunbelt market without understanding what 14% builder incentives mean for the long-term value of that home. Don't buy an FHA-financed home in Cape Coral, Lakeland, or Austin, assuming prices recover quickly. They might not. 6 rate cuts didn't bring rates down, and a war just sent them back up. This is the slowest motion mortgage failure in modern American history. It's not a crash, it's a grind, and the grind just got worse. If you're not subscribed with notifications on, you're going to miss the next one. Next video, we're ranking the top 10 U.S. cities most at risk of double-digit price declines through the end of 2026. And one of them is in the Northeast for the first time. Hit subscribe, tap the bell, drop a comment telling us what city you're watching, and we'll see you in the next one.